Hello and welcome to PolicyCast, Grant Thornton Bharat's podcast series where we unpack the tax policy and regulatory developments shaping business decisions in India. In today's episode, we discuss about the Taxation and Other Laws Amendment Bill 2026 introduced shortly after the Income Tax Act 2025 came into effect. The bill not only gives legislative backing to the government security exemptions introduced through the June ordinance, but also proposes important changes impacting fund management, electronics, data centers, rough diamond trading, and business trusts. While most amendments are effective from 1st of April 2026, certain new exemptions are proposed from 1st of October 2026. The CBDT has also issued FAQs to clarify several provisions. To help us understand the key changes, their practical implications, and what businesses should prepare for, we are joined by Riaz Singna, partner Grant Thornton Bharat. Riaz, welcome to PolicyCast.
Thank you.
So, to start with, what is the common policy thread and which elements should listeners regard as genuinely new?
So, at first glance, the bill may seem like a set of unrelated amendments. However, its underlying objective is clear. The statement of objects and reasons explains that geopolitical developments and supply chain disruptions have created economic uncertainty, prompting tax measures aimed at supporting sectors most affected by global conditions and improving India's attractiveness for international business and investment. The bill continues certain measures introduced through the June ordinance, including tax exemptions for foreign institutional investors and the Bank for International Settlements on interest earned from government securities and capital gains from their transfer. At the same time, it introduces several new measures such as easing the conditions for eligible investments of fund safe harbor, providing a longer and more clearly defined runway to electronics contract manufacturing arrangements, making data center exemption less dependent on entity specific approvals, and providing exemption for qualifying rough diamond sales and component warehousing. Also, aligning the dividend exemption from REIT and InvIT unit holders with the SPV's eligibility to enter the new corporate tax regime. So, this is not a complete recast of the new Income Tax Act. It is an early calibration of selected provisions based on the feedback received.
That's very well summarized, Riaz. One of the most prominent proposals concerns the eligible investment fund safe harbor. What is being simplified and what safeguards remain?
So, the Income Tax Act 2025 provides a safe harbor provision under which fund management activities carried out by an eligible fund manager does not create a business connection in India for the foreign fund, subject to stipulated conditions. Presently, 13 conditions for the fund and 4 for the manager are specified. Of course, there are certain relaxations for Give City. The bill proposes reducing the fund side conditions from 13 to 5. On the manager side, the prescribed minimum remuneration requirement is proposed to be removed. This is a welcome move as it focuses the test on the fund's residence, ownership exposure, and Indian business nexus rather than requiring compliance with longer set of structural and portfolio metrics. It will also encourage availability of genuine fund management capability in India.
That's an important distinction. While the framework is being simplified, the safeguards are clearly not disappearing. Let's now move from capital flows to manufacturing, another area that features prominently in the bill. India's electronic manufacturing ecosystem has been growing rapidly, and the bill appears to address both long term investment and supply chain requirements. Could you walk us through how these proposals work together?
Sure. The bill extends the tax exemption for capital goods and equipment supplied by a foreign company to an Indian contract manufacturer in a custom bonded area by another 10 years, that is up to FY 2040-41, subject to certain conditions. It also narrows the scope by limiting the benefit to a specified list of electronic goods. From October 1st, 2026, income earned by a foreign company from storing components in a custom bonded warehouse for use by an Indian contract manufacturer will also be exempt, provided the components are used to manufacture specified electronic goods. Together, the provisions recognize that a contract manufacturing model requires both production assets and timely access to component inventory. The new warehouse provision is nevertheless a conditional exemption, not a general exclusion for inventory trading in India, and the exemption is proposed to run up to the tax year ended 31st March 2041.
That's interesting because the changes seem designed to support the entire manufacturing value chain rather than a single activity. Now, data center services and rough diamond trading are very different activities. What commercial operating models does the bill seek to recognize in these two areas, Riaz?
So let's start with data centers. The bill broadens the tax exemption by covering leased infrastructure and replacing entity specific approvals with an objective eligibility condition. CBDT FAQs also reiterate a 15% safe harbor for certain related party arrangements. The rough diamond proposal, on the other hand, follows a different model by exempting income on sale of rough diamonds in a special notified zone. It extends to a foreign company engaged in the business of diamond mining, a stakeholder of such a company, a broker, aggregator, or tender auction entity connected with that business. And basis the clarification given in the FAQ, such specified zones presently are Mumbai and Surat. In essence, the bill makes the data center regime simpler and more flexible while creating a tax efficient framework for diamond trading through designated hubs.
Okay, so let's now turn to another important stakeholder group investors in business trusts, REITs, and InvITs. What exactly is changing for the investors in business trusts, REITs, and InvITs, and why does it matter for them?
So the bill removes an unintended tax disadvantage for REIT and InvIT investors. Under the current rules, dividend income distributed through a business trust loses its tax exempt status if the underlying SPV opts for the new concessional tax regime. The proposed amendment ensures that investors can continue to receive tax exempt dividends even if the SPV chooses the new tax regime. However, the change applies only to dividend income. The tax treatment of other income streams, such as interest from SPVs, rental income earned directly by the REITs, etc., remains unchanged.
So, what's driving the need for this change now?
The change, to my mind, is largely driven by the MAT reforms introduced in Finance Act 2026. These reforms have made the new tax regime more attractive for some SPVs, especially those with accumulated MAT credits that can be utilized after switching. Without this amendment, an SPV's decision to move to the new regime could have resulted in investors losing their dividend tax exemption. The bill removes this unintended consequence by ensuring that investors continue to enjoy the dividend exemption regardless of the SPV's tax regime choice.
So, is this purely a tax benefit for investors, or is there a trade off elsewhere?
Now, there's definitely a balancing element. While the bill preserves the dividend exemption at the investor level, it proposes a higher surcharge for SPVs of business trusts that opt for the new regime from 10% to 25% for SPVs of business trusts effective from 1st April 26. So there has been a trade off.
Okay, so are there any unresolved issues or areas that may still need clarification?
Yes, there's at least one technical point we'll be watching closely. While the bill preserves the dividend tax exemption, The withholding tax provisions may still require business trusts to deduct tax on such distributions. If that is the case, then investors could face avoidable cash flow and compliance burdens despite the income being exempt.
Riaz, thank you so much for taking us through the proposals. And to sum it up, the bill is more of a fine tuning exercise than a major overhaul of the new tax law. It simplifies the eligible fund framework, extends tax incentives for electronics contract manufacturing, streamlines the tax regime for data centers, introduces new exemptions for rough diamond sales and component storage, and continues the dividend exemption for REIT and InvIT investors while increasing the surcharge at the SPV level. While the bill has been passed by the Lok Sabha, it still awaits approval from the Rajya Sabha and the President before becoming law. The real impact will depend on the detailed rules, reporting requirements, and the final alignment of withholding tax provisions for business trusts. Thank you so much for joining us on PolicyCast today. Stay tuned for more practical, expert led discussions on the tax policy and regulatory developments shaping the future of business in India.